If you're struggling or break-even trader and frustrated that you just can't break through, in this video, elite 8-figure prop trader Lance Brightstein shows you how avoiding one small but deadly mistake could change everything for you. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading career.
In this video, I'm going to be presenting a concept that can make all the difference. Are you on the cusp of becoming profitable and need a little boost? Can you imagine how incredible it would feel after all your hard work to break that barrier and take on the identity of being a consistently profitable trader? Do you have some really awesome trades but tend to give back that hard-earned P&L on the same ticker? How would you like a concept that will push your win rate over the edge and transform your trading? So many traders make the same mistake, and this concept has helped them improve their game. I've seen break-even traders become consistently profitable simply by internalizing this concept and incorporating it into their trading. A lot of the times, the easiest way to increase your bottom line is to avoid some of your easiest losses. This so often tends to be the lowest hanging P&L for you to capture. After mentoring hundreds of traders, one of the most common mistakes these traders make is a concept that I call trading in no man's land. Let's dive into what this concept is, how to identify it, and most importantly, how to avoid making this costly mistake in your trading. No man's land is the term I use for when stocks are trading in a range and volatility is contracting. So often, traders can catch a really nice leg in a ticker, then keep on sticking around to the mental bias of just having made money in that name. Most traders haven't analyzed their data enough to recognize that likely 90% or more of their paper cut losses in churning tends to occur when the stock is done making its move for the time being and needs time to consolidate. This applies to both longs and shorts. While admittedly most of my later examples end up being long examples, this is just due to chance. It applies the same to both sides. So to be clear here, it isn't that I'll never ever make a trade in no man's land, and it isn't that there's never good opportunities in no man's land either. It doesn't mean that trading in no man's land never works. All it simply means is this: the probability of a clean move is much lower and the probability of paper cut losses is much higher in no man's land. As a result, I tend to be sized much lighter if I'm involved at all. Oftentimes I'm okay sitting on my hands until the stock is consolidated and then finally breaks that range. So here's an example on a daily time frame that I wanted to share. And this is Tesla. A couple years ago, it used to be the 900 level, but now after the reverse splits, it's $300. And so let's say, focusing on the long here, it makes this move up to 300. We then start to pull away. Once it's pulled away, if I make any long trade, it's only going to be a super small, lighter trade. Big picture, we've got that whole overhead resistance. Now what happens is we consolidate for many months and we start to get tighter and tighter to that $300 level. Once we break out, that's when it's green light. All bets are on, all engines are churning. That's when I really want to go big. And that's because we're breaking out of that whole range. We're going to all-time highs. So often my win rate and the reward and therefore the expected value is so much better in that area versus when you're still below that overhead resistance. Here's another example on an intraday basis. This was the ATVI breaking news as their pending merger started to get closer to the finish line. What you'll see is we make that first leg higher and then we start to pull back. Pretty much as long as we're so close to those highs, in that red box area, I don't want to be still playing long. The only place where I want to be long is when we start to tighten up, we've consolidated after such a big move, then boom. We break that level, we're at intraday highs, and that's the type of place where we've now exited no man's land, we're in new price ranges. That's where I want to be really placing my chips. A final example for now is this WAL bounce play during the banking crisis back in March. This was the really crazy day where it melted off pre-market and off the open, then had that huge bounce. So let's say we catch that huge leg higher after multiple halts. Once that turns, I really want to be wary of getting long again. And what you'll see is there's a lot of turns within that price action that wouldn't end up clean. In a lot of places, when you're playing long inside no man's land, you're going to end up being stopped out. You're going to end up churning. You're going to end up taking a bunch of paper cuts. And I'm not saying you won't ever catch a nice pullback, but again, it's just that the odds aren't so good. Where I really want to wait is for when we break that range and break out of no man's land to intraday highs. This other example is finally going to be from the short side. So APLS, they've been having issues with their iDrug. This was one of those days where it really melted off the open. We come to some form of a bottom. And while we're consolidating down there, I really don't want to keep on shorting or looking for that other leg. And as you can see, there's a lot of places where it looks like we're going to start to break to lows, but we end up holding that level. So normally so many traders think, oh man, this stock is so weak, it can't bounce, it's going to go lower, it's going to go lower. But again, I'm okay not touching anything in there from the short side. This particular chart wouldn't interest me for a bounce either, so I'm totally hands off. The only place where I would be okay reinitiating a short is if we break those lows below that yellow line. So what are the exceptions to the rule? As with anything in trading, it's all about nuances and there's always exceptions. One of those exceptions is if there's fresh breaking news. If there's fresh breaking news, all that prior price action isn't so relevant to me. You know, you're not going to wait for a break of no man's land potentially. You just want to be as quick as possible to trade on that news. Another exception, if there's a really tight consolidation within no man's land. And I'm going to show you a couple examples of this, both in the XPEV daily as well as an intraday chart from EOSE. Another example is if you have a really clear support level and you want to buy a pullback into that, or if there's clear resistance level to short a bounce into within no man's land. And so nevertheless, I still want to be conscious though that these are lower probability than when we're breaking the whole range overall, and therefore, again, size accordingly. So here's a couple examples of those exceptions. So this is a tight consolidation occurring in EOSE. So this was a stock that made a leg down on a short report, and we went from $3 to around like $1.20 or so, and then we did about a 50% bounce. Normally, I would be pretty cautious after such a retracement. Normally, I wouldn't be so keen to trade it long or even short while it's in the dead middle of that range. But what you can see is, one, this is like a pretty liquid lower price ticker. And two, in those two boxes, those red boxes, we end up having some very tight consolidations. So if I play that bounce play and then I'm looking for like a continuation higher, if I'm going to play it long, given how nicely these consolidated and how tight that consolidation is in those boxes, I really don't mind playing that long continuation play in those circles when we break above. Another thing highlighting this concept is this daily consolidation in XPEV. So XPEV has a daily range of being about $6 to $13. Normally, I don't want to be long in the middle of that range, and I want to wait for that break above the range. But what happens is we form a much cleaner and much tighter resistance level at $12. Because that level is so clear, I'm okay getting long above 12, even though the high of that range is 13. What then might happen is that break of 13 can even be another place to add if desired. And so a thing that I want to point out is so often using this concept of no man's land, a lot of traders that don't follow this, they'll be taking so many losses in no man's land that when it comes to the true breakout, I hear it all the time, they end up undersized or skipping on it. And so many times they'll say, why didn't you buy the breakout? Well, I took 2-3 attempts earlier. And that's the true power of this. It's not that you're never ever going to miss a leg, or it's not that you might not be able to get better prices. It's that in the aggregate, this gives you the firepower and the mental capacity and the focus to be in it on the true breakout rather than turning yourself and taking those paper cuts that can prevent you from being sized in it when it really does make the move. So how do you implement this into your trading? So first, I would drill down into your own definition of no man's land. I shared with you what works for me. And in the aggregate, you want to ask yourself, where do you tend to paper cut yourself and give back your gains? What are the signs a ticker might be done trending? Is it perhaps that the volume is dying? Or is it that the Bollinger Bands are contracting? Perhaps anything between the current day's range you might define as no man's land. It really depends you and your system and what tends to be backed up by your data. Practice identifying whether in real time you can identify your own definition and test yourself on this for effectiveness. Continue to collect that data to draw conclusions as to what works and doesn't work for these areas. Using that data, you can then create a rule set to reflect on when a stock is in no man's land. Perhaps that might mean less sizing for you, or perhaps that might mean a maximum number of attempts, or maybe it means avoiding that trade altogether. Track the effectiveness of these tweaks along the way, and that's how you can really start to make this your own. Let me give you a few practical examples of such rules. If a stock is still trading within the range, any trades I take will be 25% size, and at max, I want to give it 2 attempts. That seems like a super reasonable rule and way to adapt some of this. Another way could be, I'm not allowed to short a stock after a large down leg unless it's consolidated greater than 30 minutes and then breaks to intraday lows. Or another example, I can't execute a trade in no man's land unless the volume is staying as high as it was during the leg it made. And a final one, I will avoid all continuation plays unless we break to fresh intraday highs. Ranging from the simple to the complex, these are how you can take your data and build rules that help proactively change your trading. And so trust me, this concept applies to you. Regardless of skill level or style, this concept is so important because it helps us identify another key variable in our trading. And that's whether a stock is still in a range or breaking to new prices. Almost all traders I've worked with don't differentiate their trading granularity enough based on this concept. Once traders take the time to look over their trading and reflect, it is almost universal that somewhere they are being blind to these nuances and have room for improvement. One of the most common sayings you'll hear me say to my trainees on the desk is, stop obsessing and studying how to master the Jack 5. Focus on the pocket pairs. One trader I trained would always ask me about the really marginal no man's land setups that I considered to be 50-50 and mediocre. What I meant by this poker analogy to him is that mastering the mediocre hands doesn't get you anywhere. This trainee eventually got the point and started mastering the setups where the stock was breaking to new prices. That ended up really transforming his trading and saved his career because so many of his losses were coming from trades where it was stuck in the ranges. Those are what I consider the mediocre Jack 5s. Once he switched to only trading the pocket pair breakouts, it was game changing. So make this concept your own and improve your win rate, hold on to that hard-earned P&L, and elevate your trading game. Thank you so much for watching, and feel free to comment below. I'd love to hear any questions, and let's see if I can help you even more.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.